My name is Don Campbell, founding partner of the Real Estate Investment Network and senior analyst. And we've been studying these real estate markets ups and downs for 20 long years. And it's great to be here. The one thing that I've learned over the many years I've been investing is you have to manage your expectations. You have to understand the realities of the market. The unfortunate thing is when the market starts to slow down, a panic sets in for the majority of people. And when the market's on fire, they think they're absolute geniuses. And the truth is always in between. You're not any smarter or any dumber when the market goes up or down. It's your job as an investor is to look at the markets, have its reality, have your ideas around the reality of where it's going to go. If you're looking at housing stats to try and decide which way the housing market is going, you're 18, 24 months behind all the sophisticated investors. So why not start looking and managing the expectations and seeing where the market's going to go based on job growth, inventory, those types of things, rather than, oh, the average price is up, oh, the average price is down. You know, if we get a market that goes up 3% a year consistently, you know, just on average year over year over year, you're going to look like an absolute genius when it comes time for you to check out. So why not just manage that expectation? Don't expect a home run. Well, the mixed signals are coming out from everywhere. Now, of course, the internet plays a role in that because everybody has column inches to fill. So they think if I state something emphatically and loud enough with the biggest and ugliest headline, then I'm going to get more eyeballs. And the unfortunate thing about that is it's manipulating the market and the market mentality. And once we go back to the managing expectations, manage your expectations by looking at the right factors and listening to people who don't have a vested interest in you buying or selling your property. Your job as a sophisticated investor is not to believe and not to buy into the headlines. Your job as an investor is truly to kind of look at the data, look at the facts and the figures, and look through what really drives the real estate market. Then you can decide. And if you have a 1-year timeline, if that's your thought process, then you need to really pay attention to ups and downs in the market. But if you're like most sophisticated investors where you have a 5, 7, 10, 12 year, then you don't have to get too high when the market goes high and too low when the market goes low. And that goes back to looking at the right signals. So, number one, if you're a short-termer, a 1-year, 2-year thing, you should be concerned about your ability to sell the property in downtown Toronto, especially a condo, or downtown Vancouver. Because during the next year and a half, 2 years, there's going to be a lot of mixed signals. There's going to be a lot of properties that come on. There's going to be a lot of volume. So your ability to sell will not be as easy as it was over the last 3 years. But after that, that inventory will get taken up by the population growth and the job growth, and then you'll start to feel the upward pressure again. You're going to have some stability in the market. If you go elsewhere across the country, you're going to go to the Calgary or Edmonton, where the population's growing, the GDP's growing, the vacancy rates are falling off, the rents are going through the roof, and there's limited inventory. You know that market in a 1-year, 2-year, 3-year is going to be easy to sell into. So you can't go the average Canadian real estate price, because that means nothing to anybody other than somebody who's writing a headline. The average rent means nothing because you've put penthouses in with basement suites. So please really narrow it down to what matters to your area, know your timeline, and just because the market changes doesn't mean your goals change, just your tactics change. Vacancy rates start going up, what do? You get better at marketing because you might as well be full and let somebody else be empty. If the rents are going up, then you better keep your rents up at that level, or you're going to get people who are the more money-chasing renters who are going to constantly change, and you'll have higher turnover. So please make sure that as you look globally, you look nationally, you look provincially, and then you look right into your city, your target city, because a national number means nothing. There are three things. Now, if say I'm going to buy in Toronto or Vancouver or somewhere, what I'm going to do is this. Quite clearly, I am going to focus on an area that's serviced by subway or express bus, something, or even GO train. That's what I'm going to focus on, because as energy gets more expensive, people are going to park their cars. What they're going to do is the increase in demand on TTC and SkyTrain in Vancouver, et cetera, is going to continue to go up. I think it's up 6% over the last couple of years. That's a big deal. So I would do that. I would look for a region or a house that is an older house that I can add value to by renovating. And I would look for one that I can legally put a suite in if I'm a first-time home buyer, because properties are expensive. Might as well let somebody else pay a bunch of the mortgage for me. So it's an older property that I can add value near some sort of transportation change and in a region and a neighborhood that's going through a transition. The transition is going to be key. Don't buy in an area that you hope is going to go through transition, because pioneers don't live. But an area that's already going through, like a Mimico, for instance. I love the area. It's close to the lake. It's getting serviced by decent service by transit and lifestyle and older properties. There's opportunity in those type of regions more than buying new. So the transportation is something that we studied in and out. And what it does is, if you're buying within 800, 900 meters in that kind of zone of a GO train station, a TTC station, a C train in Calgary, you're going to get a lift of 10 to 15% higher than the rest of the market. And if you want to play defense, the market, when it starts to come down, will go down 10 to 15% slower in those target areas. Pretty good. We have to play offense and defense. If you're renting, 2 bedrooms rent for upwards of 20% more within that 800-meter walking distance. So you win all over. It's a slow process, and especially with the way that governments are right now, especially out east where they're struggling for money. They'll make lots and lots of announcements, but the announcements don't make me buy. Only the digging makes me buy. And even in Toronto, we've seen where they dug and then they filled the darn hole back in. So there are some anomalies. But if you start to chase the TTC, look at what's going on in Vaughan. The TTC is going out and there's going to be a station in Vaughan. Well, just last week there was an announcement where I think it was a multi-billion-dollar project. It's going to be right at the end of that TTC station. So we've been talking about that for almost 3 years, that this is coming, this is what's going to happen, it's inevitable, and a lot of people have kept their foot on the brakes, and now they're behind the curve. So I suggest the Scarborough, the TTC expansion is going to play a major role in the redevelopment of Scarborough, especially the areas right around the new stations. Because it's less affordable. I mean, it's less affordable to live right down in the CBD in a central business district than it is in Scarborough. Same with Hamilton. You've got the GO train. They're twinning some of the tracks, so they're going to be able to go more often. Those types of things are going to be the gold. It's almost like a key to the vault for real estate investors. So the market is going to go up and down. It always does. For 20 years, I've seen it go up and down, and the bulls screaming when it goes up, yay, look at me, and the bears screaming, yay, the market's crashing. And your job is to cut through that crap and look at the research and really buy smart. Be mindful when you make decisions instead of emotional when you make decisions, and you're going to win. Sure, it's a different style of book. Wiley North America, or Wiley Worldwide, has a series of books called The Little Book Of. They have The Little Book of Value Investing, The Little Book of, and all these people have written these books. And they approached me as the first Canadian ever to write one in that series. I was very, very proud to get that. And it's called The Little Book of, surprisingly, Canadian Real Estate Investing. And what it does is it changes. I have to be a little more vulnerable in this book, which is really uncomfortable, right? All my other books, the Real Estate Secrets of the Canadian Real Estate Cycle and Real Estate Investing in Canada, they're pretty technical. They're stories, but they're technical. This one here, I have to go right down to when I met my wife 26 years ago and the story behind that and how that played into our real estate. And it was very interesting to be able to speak to lots of investors who have been along the path with me, and be able to put that in this book, But my goal with this new book is quite simple, and that is to boil down the ultimate secrets. The ultimate secrets to get the investor and the home buyer to understand how to make the decision. So it's called The Little Book of Canadian Real Estate Investing, and it's on pre-order right now at Chapters on Amazon. And 100% of the royalties, once again, are going directly to Habitat for Humanity. I don't make any money on these books, but you will if you read them. Why Habitat for Humanity? It's really, really quite simple. And that is, I've seen the impact that owning real estate can have in ups and down markets on a family, the psychology of a family, the finances of a family, and the long-term effect that it can really start to have a positive effect on the children, not just the parents, but the children, and then it changes their wiring, in essence. And so how do we do that? Well, we give them a hand up instead of a handout. So what we've done is, with Habitat for Humanity, I've taken all my royalties, and the Real Estate Investment Network, all the members have such giant hearts. We've now raised about $900,000 for Habitat for Humanity, which is bigger than our goal. Our goal was 20 grand. And what it does is we build houses, and then a small mortgage gets put on those properties. The people who move in have to pay those small mortgages, but the cool bit about that is, now that you've got a mortgage on it, you go take that same money and you go build another one, and you go build another one. So this 900 grand never disappears. It's not admin. 100% goes to building houses to give people a hand up, not a handout. And that resonates with me because I know the ripple impact over generations that can have. Why become a REIN member? We've been around 20 years. We've been up and down the markets. We study them in depth, constantly, a little obsessively. And what we do is we boil it down to, are you a short-termer? Are you a long-termer? We give you the answers. We don't sell real estate. We don't do any of that stuff. We're able to just stand up and support the average real estate investor, to REITs and wealth funds, etc., making decisions not based on headlines, but analyzing all of the data, so that you can go and go, real estate's not for me, or real estate is for me. And the best thing about the Real Estate Investment Network is the community of what you become. And you're in a community of people who are taking action, not a bunch of people who are talking. So you know what? It's an honor to be a part of that community. But truth be known is, don't come if you're a speculator, that you're just rolling the dice and you want to get rich quick. We only talk about fundamentals and really building long-term sustainable wealth for you and your family. TheRedPin.com. Well, just think about that for a second. The name is brilliant, because it came up at the exact right time when this red pin thing was all starting out. Where's the hot spots? And I watched it, and I watched the process that was going on with the growth of RedPin, and watching them use technology to support home buyers and investors. Brilliant. But what really, really, really got my attention was the ability for the average home buyer and investor to get into that MLS data just like as if they were realtors. And I don't think there's anywhere else in Canada that you can really get that depth of information. And information is how you make smart decisions. So smart decisions lead from TheRedPin.com. And that's what I like. I like information, data, ease of use, and the ability to help make quality decisions for people. No spin. It's fantastic.